So we just saw one of the biggest rallies we've seen for a couple of years. And in fact, it was one of the sharpest rallies whilst we've been in a bear market since 2008. So it was very significant. But really, what is going on right now is that obviously the report came out of the US on Thursday, and it was a lot lower than expected. We've seen inflation be the big elephant in the room for the past 12 months, and we've seen interest rates going up. We've seen inflation going up. And what we saw on Thursday was an inflation report that showed that inflation is now 7.7% in the US rather than 8.2%, which is the previous month. So what we saw was a lot of relief. What we saw was a lot of money that was been sitting on the sidelines waiting for inflation to start to come down came flooding back into the market. So there has been a lot of tightening going on in financial markets this year. Monetary policy has been tightening. So the Fed in the US, the RBA, and all of the central banks around the world have been doing a lot of work with getting interest rates higher. And that's been causing the financial markets a lot of pain because higher interest rates means volatility around share prices because there is some money that will come out of the market into fixed income. And when you get a market that was so stretched after 2020 and 2021, you've got to give consideration to the fact that the S&P 500 was up about 24% in 2020 and about 26% thereabouts in 2021. It's just not realistic for the market to have another strong year when you've got interest rates going up and a market so stretched. So there's been a lot of work being done so far. And what we can see now is that there is light at the end of the tunnel. We can see the fact that inflation now is starting to meaningfully decline. And I've been saying it all year. There is two elephants in the room, one inflation and the other is interest rates. And the share market is only going to go back higher and move towards all-time new highs until we see two things happening. One, inflation meaningfully starts to decline. And number two, the interest rates that these central banks have been putting up, they pause them, or even into 2023, well, if we do see a recession, they start to reduce them. And that's going to be a tailwind for share prices if that actually happens. But right now, there is a lot of relief and there's a lot of thought that, hey, all this work that central banks have been doing it is actually working. Now, what we saw, which also is important, is the US dollar started to decline. The Aussie dollar, I suspect, will probably continue to rally, maybe upwards of around 70 cents before the end of the year, maybe even a little bit higher than that. The US dollar acts as a safe haven currency in times of uncertainty, and there's been plenty of that this year. But the US dollar, also with the Fed, there's about a 1% interest rate differential between the RBA and the Fed right now, and that's been leaning towards the US dollar going higher. That is going to reverse somewhat. And what this is going to also be a tailwind for is some company earnings. A lot of companies that in the US, particularly a lot of the big tech businesses like Microsoft, etc., price their services in US dollars. And that's been costing them some money recently with the US dollar being so high. So the US dollar coming lower is going to be good for company earnings for many of those big tech businesses. So that's also going to benefit. And that's one of the reasons why the NASDAQ was up about 7% through that Thursday trading session. Now, what we're seeing right now is, the lag effect of high interest rates is going to start to come into play in the next few months. We've seen home sales well down, used car sale prices well down. We've seen rents coming down now. We've seen shipping costs coming down. I just spoke to a buddy of mine in Canada, some text messages today about he agreeing with the fact that shipping rates are likely to continue to go lower in the short to medium term anyway. And this is all helping inflation lower. We're seeing at the moment another positive thing is all of these layoffs in companies all around the world. And you might think that's a negative. It is for those folks getting laid off, of course, but for financial markets, it's a positive because it's going to mean the demand starts to get crushed even further. People without jobs can't go out there and spend their money at the same pace that they have been doing. So there's been a lot of layoffs. So the bottom line is we are well past the peak of inflation, And, I expect that the US Fed will pull the trigger on 0.5% interest rate increase in December. And I think the RBA will go with 0.25%. But after that, into January, February, March, I think there is every potential they may pause. The RBA doesn't meet in January, but the Fed does. And there may be a chance that markets get a few months without any rate increases at all, which is going to be another tailwind. So right now, there's a few seasonal things that are helping markets right now into Christmas. One is there was no red wave with regarding the midterm elections. Seasonally speaking, after midterm elections for the next 6 months, markets are generally higher on average. Last 18 midterms, when the market gets over the midterm from that point onwards for the next 12 months, on average, the S&P is up 30%. That is very, very significant, guys. Very significant to remember. Not a guaranteed certainty, but it's a significant historical fact to keep in mind. Also, right now, seasonally, just from an annual perspective, on average, October to December is the strongest time of the year. But one of the things that I want to point out is there's been a lot of traders very bearish on the market this year, taking short positions, making money as the market's been going down. Those traders, if they maintain those short positions, are toast. Because what we're going to see is anyone who's been maintaining a short position and a view that market's continuing to go lower, they've been doing that because inflation's continuing to go up and interest rates are continuing to going up. That's now reversing. Inflation is coming down. The probability is interest rates will not continue to go up at the same pace, maybe once more, and then that's it. And the market is now going to price in a US Fed and RBA and other central banks being a little bit more dovish rather than being so hawkish. So a little less aggressive rather than being really aggressive. So all this points towards a strong rally into the end of the year. What happens in 2023? I believe that's going to come down to company earnings. I don't believe the market's going to worry about company earnings between now and the end of the year. We're just going to see a market rip higher potentially in the next few weeks and months. Until the end of the year, we've only got about a month and a half to go because we've had such a strong bear market. We've had the S&P down over 20%, NASDAQ over 30%. The money managers are going to want to get this market back close to square as they can before the end of the year. But in 2023, what the focus is going to be on is company earnings. What are the companies going to be producing with respect to profits? And how deep is the recession going to be? I think there's no question we're probably going to have a recession. It would be the first time in history that inflation has been this high, come down, and we not had a recession. So the probability is we're going to have one. I believe the market in 2023 in the first quarter into the second quarter will focus right back on company earnings because the focus won't be on how high interest rates are going to go or how much high inflation is going to go. Inflation will continue to go down. Unemployment rate will go up. And the housing market and all of those other markets that really suffered in 2022, they will start to see a little bit of relief as the economy starts to unwind a little bit and we start to see share prices go back higher. Central banks pause on those rate increases. It's going to get a little bit of room for investors and others in some markets, such as the housing market, the share market, etc., to get a little bit more aggressive again. So what we saw on Thursday was the best thing that could have possibly happened for those of us that have been really patient through 2022 and continue to invest. I do think that we will see a significant rally between now and Christmas. I've been calling for it for the last few months. I might have been a little bit early, but I don't think I'll be early any longer. And there would have to be something really, really significant happen for the market to turn around and get bearish again now. Inflation is not going higher. Inflation is going lower. Central banks know that. They'll raise rates one more time likely, and then we may see a pause. But right now, you won't want to leave your money sitting on the sidelines if this market gets going, because those of you that have, you've already missed about a 7% rally on the NASDAQ, a 5% rally on the S&P. You can't afford to be out of the market when we see these ripping rallies happen. There's about a 25% decline still on the NASDAQ. That is likely going to close somewhat between now and the end of the year. That's where we are, guys. Hope you enjoyed that. Any questions for me, put them in the comment section below. Have a great Friday.